Hello and welcome back to Crypto. My God, there's a lot going on in terms of laws and the developments in the land of cryptocurrency. Let's get right into it. Okay, so one of the big pieces of news that came in is that the release of the market structure bill has come out. This is going in front of the Financial Committee and the House Agricultural Committee. But what it goes into is basically trying to define a lot more of the statuses around these assets. Are they securities? Are they commodities? Who regulates them? How do we regulate them? And what's going on? Now, this thing is like 212 pages of just chonk, so I'm going to need some help in unpacking it. Here is the full draft for anybody that wants to read it in its fine legalese, black and white. I don't think that's going to scratch many of your itches, so I will thank Matthew Sigel for just a very brief TLDR. What he goes on to say here, new U.S. crypto market structure bill just dropped. Looks like a major upgrade from FIT 21. No income wealth limits on retail buyers. No accredited investor or suitability checks. That's good. That's a very big gatekeeping factor. Clear decentralization test. No unilateral control. Greater than 10% of the holders must be disclosed while the project is still centralized. We've talked about disclosures, how important that is. DeFi protocols exempt if they're non-custodial and don't exercise user discretion. Again, how do we intermediate? How do we put rules on human intermediates when they're really just algorithms, right? Define stablecoins without calling them securities. Sure. Optional early registration path. Real joint SEC, FTC, CFTC rulemaking. So this is an interesting start. However, my buddy Gabe Shapiro from LEXNODE took clearly over the last couple days has put in a lot of sweat and effort in order to break down his thought on the digital asset market structure bill. His take is a little less rosy. And as you go through it, I think this is a really nice way to get a handle on what's going on. If you do want a deeper read, obviously the bill itself is kind of maniacal in its length and its depth. And he goes in good news, bad news. Bad news, the bill is still basically just FIT 21. Good news, those modifications for the most part actually make it much better. But he goes on and kind of describes that what the bill is supposed to do is really represent fair trade. We eliminate the gray cloud of legal FUD hanging over you, especially around securities law status of tokens. That was huge. That was Gensler's primary cudgel during the last 4 years. So regulators and class action attorneys can't play gotcha and you know what to do to be legal. I can't overemphasize this. I mean, people just want to build their businesses, and knowing where the law begins and where it ends is going to help them just avoid a lot of the tertiary BS that really is around everything that they're doing. You accept and follow clear regulations that we do now lay down, including accepting comprehensive regulatory authority from the CFTC and the digital asset token markets, and residual fraud authority and authority over capital raising process using digital tokens from the SEC. So again, we're getting back to clarity around how you raise money, what the distribution of these things look like. Now, he gets into a couple problems with it, which really comes into the legal definitions. And he begins to say it's really a tautology. It's just a circular logic coming in here. And these points kind of encapsulate it. This is essentially means that the bill is saying if a token is not a security, then it's not a security and nothing more, i.e. it's completely circular. To condense the logic, it kind of works like this. A digital commodity means a token that, among other things, is not a security. Awesome. The term investment contract asset means a digital commodity that was sold pursuant to an investment contract. Point of bill says that the investment contract assets are not securities. This is why he is saying it just says that it's not a security, it's not a security. So basically the bill is saying that the token is not a security, is not a security. The logic is completely circular. And we do see this being echoed by developers that have actually dived into this as well, like Rick Dudley, who says, I've started reviewing the legislation. If I did this for a living, I'd be even crazier than I already am. 100 pages filled with basic logical flaws. Whoever wrote this is the worst coder ever. So as we get into the weeds of people in the industry, I mean, it is looking a little bit discombobulated, a bit of a clusterfuck, and not alleviating the confusion that we had all hoped, right? This is really what we want to get out of this admin, is clear regulation around how tokens are supposed to be treated. And of course, this brings us to this stablecoin bill called the Genius Act, which I've covered in the past and is now going up in front of a congressional committee. We have Dixon here from A16Z talking about how it's time to pass bipartisan stablecoin legislation. The Genius Act will protect all the consumers. Sure, everybody wants to see these fucking stablecoins get regulated. I mean, it should be as straightforward as possible. Of course, you got Brian Armstrong here. Congress has a real opportunity this week to advance stablecoin market structure regulation. Now, one thing I really do want to point out is that there is one gaping flaw that I believe is inside this genius bill as well, which is that there is no yield-bearing stablecoin assets. This is basically, in my mind, especially a mind that's coming at Bitcoin as a disruptor of the banks, this is just a cash grab by the banks, saying if there's stablecoin yield generation, why would people hold a bank account? But where is that yield going? Right? If banks begin to launch these stablecoin products, it's, again, if you remember from my previous episodes, this is like a lower end version of a money market account. They're basically taking $1 from you, they're buying T-bills with it, and they are keeping that yield in their own pockets. So by saying that a stablecoin cannot issue yield, I mean, sure, you can make some posits around the safety of the banking system, yada, yada, yada. But what this is saying is that they don't really respect the consumer, that they want to keep treating the consumer as a cash cow. They only want stablecoins that allow them to increase their own profit margins. You can take that how you will. Obviously, it will be nice to get some stablecoin legislation so people can build real businesses, but this is not the liberation from the TradFi banking world that Satoshi had envisioned. In fact, it is quite the opposite. And with stablecoin adoption becoming the largest thing on chain, I mean, you really do have to get back to the roots and question, what are we all doing here? I know a lot of VCs and investors that are very big on Ethereum's narrative as the decentralized world computer are also going all in on stablecoin projects. Of course, there's great returns there, but again, philosophically, we may have to call bullshit on a lot of people. Now, the Genius Act is up in front of Congress. There was supposed to be an alignment, but in the 11th hour, about 5 or 6 Dems who were pushing it forward have actually pulled back on this. So we're seeing, despite Maxine Waters' theatrics this morning, the nonpartisan work continues. This is Tom Emmer. This is the most pro-innovation, pro-crypto Congress in history. The Financial Committee is going to deliver a framework for digital asset regulation, regardless of political theater. This is the Democrats in their small group withdrawing their support. Now, this is a very frustrating thing. I mean, it had full support moving forward, and it brought everybody to Washington, D.C. to get in the same room to discuss, to debate, to hopefully grow this bill. And that Dem withdrawal of the hearing is saying, hey, you're not even giving us the time of day to listen and give feedback on all these things. And that's quite frustrating. Now, the core of this, and to me, this is a weed in our industry that will probably proliferate as we do go deeper into the summer. The sun is obviously a strengthening agent for the weeds. And what we have is the Democrats responding to the meme coin grift from the Trump family. So basically, all of this support that they were going to give towards stablecoins, towards regulation, towards clarity is being mired by the fact that the Trump family is cashing in on crypto. It's creating problems in Congress. So the Trump coin dinner, World Liberty Fi, this is all beginning to taint the congressman's point of view, right? It's going to be very hard to go back to your base and say, hey, I supported pushing forward crypto, which looked like it really pushed the Trump vote over the line in the election itself, meaning that it had broader support. But as the grift continues, and the reason I started this whole show was to try to separate the grift from the good. And we're just seeing this administration blur those lines. So this is pretty damaging, and it's a major concern coming from me on my end. To get a little bit more positive, as the stablecoin bill is mired in Congress, we do have innovators doing what they do best, which is fucking innovating. And regardless of what's happening in Washington, we have Caitlin Long, the gangsta at large, the OG Bitcoin banker who runs Custodia and has been developing a bank in Wyoming and basically fighting the good fight for so many years. Now, she posts today, milestone achieved, a tokenized dollar at VitTM issued on a permissionless blockchain was used Friday within the banking system to make cross-border US dollar payments. Custodia Bank and Vantage Bank teamed up to do it for a Mexico-based trusting and logistics company, DX Express. So even while the government does its shit so slowly, just grinds its little gears, the innovators are out there innovating. And the fact that she was able to pull off a stablecoin execution within the banking framework shows that maybe innovation just always trumps regulation. And props to Caitlin, she is just one of the truest in the entire industry. Now, on the flip side, we also have this call out to a return to negative regulation, which we're seeing in Illinois. And basically, Illinois is looking to put very onerous regulatory obligations that actually lean a little bit more towards regulatory capture. And what do I mean by that? They are trying to impose licensure upon startups. This is something that's very standard in the modern Silicon Valley world. You make it big enough in a new innovative field and you turn towards the politicians to say, hey, this is too Wild West, this is too crazy. People should need licenses. They should need to go through these grueling legal processes that are expensive, that cost time and cost money. And what that means is that only the incumbents can afford to pull off these licensures, these regulatory compliant mechanics. And that's what we're starting to see in Illinois. And it's a big buzzkill. We really don't want to see backward steps. So this doesn't bode super well for Chicago's crypto scene. That's mostly on the high frequency trading, the quant fund kind of world, but we'll see what impact this has on Illinois broadly. None of this stuff protects the end user. It just simply doesn't. We've seen that over and over again. So that's a bit of a bummer there. However, on the flip side, we're going back to some more positive news because we got to have some good with the bad, right? We can't swallow all of this medicine without a spoonful of sugar. And breaking, New Hampshire governor signs HB 302, creating the first state-level Bitcoin and digital asset reserve. So fuck yeah, what we saw fail in Arizona is now passing in New Hampshire. Again, this makes so much sense. They're the libertarian state. They're the live free or die, come and take it from me vibes, and the treasurer may now place up to 5% of total funds into Bitcoin or any asset with a 500 billion plus market cap. So that's kind of neat. I actually like that they put a market cap on that. That does take into lendiness, liquidity profiles, just scale in general, and you're not going to get the meme coin rugs when you've hit that big. Now moving on, a lot of the greater macro isn't great. So while Trump continues to grift us on his coins, he's also not being very performant as this amazing deal maker. And we're now seeing from this unusual whale post, only 9% of CEOs expected a revenue decrease in the start of the year compared to 44% now. So we're getting wild capitulation towards recessionary metrics. This is no bueno. Of course, likely impacts the price of all markets. If Bitcoin can truly decouple, maybe it goes the opposite direction. But to date, I mean, when the economy goes through a recession, Bitcoin doesn't usually do all that well. We're still getting farther into this hole. Trump's tariffs are scrambling businesses' ability to predict what happens next. Ford and Mattell are the latest companies to revise and toss out financial forecasts. So this is bad. We need forecasts. The market, the industry, the economies move on understanding consistency and confidence. They need to be able to forecast what the future looks like, or you can't very well operate your business. If you don't know what next quarter's expenses are going to be, you don't know what your revenue is going to be, this impacts how you hire, this impacts how you spend, and you have to close up into defensive posturing. This means probably firing people, lots of layoffs. This means tightening up the spending. So we are looking at regression, not progression. And instead of growth, we are going to have a shrinking economy. Now, Kyla Scanlon points out this, she's so apt on all things macro economy, but all this signposting is a little weird. And she's talking about Besant, who has been coming out and just saying so many things, right? We're talking with China. China says, no, we're not talking with China. Besant says, oh, we're going to be an anti-fragile economy and we can continue to print money if we have to, but at the same time, the printing money is the problem and we are going to fix this whole thing. So he comes out and says, if take out credit risk from government debt, rates can drop. And he keeps saying things without any actual substance behind it. So people are going to get narrative exhaustion from this flip-flopping, from this thing that does not look like it's in complete control from the head of the Treasury. And that is another factor that just simply does not bode well for us overall. Now, last but not least, I want to sign off with one piece of positive advice / revelations in bullshit, which is that this bombshell in the Department of Justice's case against Samurai Wallet founders. Now, Samurai is a Bitcoin mixing service, just like Tornado Cash. So you put your Bitcoin into a pool with a lot of other people. That Bitcoin just goes through a bunch of transactions. It turns around, it churns, and you get a similar amount of Bitcoin in return. This is just a bunch of transactions happening. Now, the thing is, this is all algorithmically controlled. It's just mathematical equations that do transactions. If I can make a transaction, and if I can make another transaction, if I can make another transaction, why can't I automate it? This is all self-sovereign things that I want to do with my money. And the crazy part is that defense lawyers just alleged that 6 months before the DOJ filed their criminal case, FinCen told the prosecutors in a private meeting that is their view that Samurai was not a money services business that required a license under FinCen's guidance. This is because it was self-sovereign and because it was self-custodial. just like Tornado Cash. Now, ironically, this all happens like around the same day that Roman Storm was arrested for exactly the same things. So we're moving forward on the same idea. All the crazy stuff I've read in crypto legal land, this might actually be the most shocking. Everyone, of course, looked at Tornado and these other cases and said, but FinCen says guidance says XYZ. Here, FinCen directly told the Department of Justice XYZ, but the DOJ prosecuted anyway, and they withheld that info from the courts and the defendants for over a year. Insanity. So this, again, comes directly back to Roman Storm, who wrote code for Tornado Cash, simply put it out there, and is still facing and awaiting a trial around jail time. The dude has a daughter. He just wrote autonomous code. It's math. This is a freedom of speech conversation. And to see that there was just such nefarious actions going on under Biden's DOJ, which again was part of this whole anti-crypto army crusade from Elizabeth Warren. And all of this shit just pushed more voters towards Trump. So it's like, what the hell are y'all doing? And are you getting the outcomes that you really expected to? Now, one thing to keep in mind is the Brady disclosure. In the legal system of the United States, a Brady disclosure consists of exculpatory or impeaching information and evidence that is material to the guilt or innocence of the punishment or the defendant. Following Brady, the prosecutor must disclose evidence or information that would prove the innocence of the defendant or would enable the defense to more effectively impeach the credibility of government witnesses. What we are looking at is exactly this. If in these trials it was known that FinCen had told the DOJ that Samurai was not a money services business, they couldn't have used that against the Samurai founders. They couldn't have used this against the Tornado Cash founders. And this Brady disclosure and the violation of the Brady Rule means that you essentially have to toss the case. So this does bode well for Roman Storm. We'll have to see how it all impacts everyone, but this is good for freedom of speech. This is good for the ability to build in the new financial paradigm, the new ecosystem, without being concerned that you're going to go to jail or have your life entirely upended. Again, we want to simultaneously clarify rules in the United States and be able to protect builders, to build the new greatest thing. Because at the end of the day, finance that is controlled by the government is anti-population. It is a mechanism that can be used against you. We recently saw Spain adding withdrawal limits to their ATM. This means that the money is broken. This is a mechanism for control, to enforce a surveillance state, and things that, like autonomous money, like blockchain, are here to liberate us, to protect the public. That being said, there's been so much going on today. I'll keep it all going for you. Stay safe out there. I know the markets are absolutely wild, and I'll see you tomorrow.